Back to tonight's edition of the debate on France 24. I'm Andrea Sankey in Paris. Tonight, what's to become of the global economy? Now, Tuesday's decline on Wall Street marked the most dramatic single-day loss on the Dow Jones since September 17, 2001. And we've been discussing what that loss might signal, as well as what else our uncharted global economy might have in store. And joining me tonight to debate that in the studio, Adrian Darnell, a journalist from Eurobusiness Media, Patrice Vial, the former chief of staff of the French Treasury and head of Hookpoint Financial Advisors in Paris. Also Max Keiser, founder of KarmaBank.com, and via satellite from New York, Stan Jonas, chief operating officer at Dutch Book. Thank you all so much for joining us again. Patrice, I'm going to start with you. I'd like to give this debate some real context. Have we seen before in history what we're seeing now via the global economy? Or is this truly a unique time rooted in unprecedented trade and interconnectivity?
Yours is a two-pronged question, actually, given the what's in the news. First side of the question is, have we observed such stock market correction? The answer is yes, and we've seen much worse. And actually in 87, as was mentioned before, we've seen much worse correction. And then the question was, will there be a negative wealth effect which would impact on the economy? And the answer was no. So that's why basically I'm not concerned by the current correction. The second aspect of your question is all the developments we see in program trading and the interconnection of all markets and the globalization of the economy, is this a new phenomenon with far-reaching implications? And then the answer is yes.
Okay. You have a comment, Adrian?
I guess the question that's on everybody's mind is the financialization of the global economy and what happens to the system when we get some shocks in the system, such as strong market corrections, and because of the emergence of hedge funds, of credit derivatives, of the fact that it's harder and harder for the central banks to identify risk and counterparties in all of these very complicated derivatives transactions, there is a lot of concern among regulators that sooner or later something unforeseen is going to happen. So, yes, I agree with Patrice. We've seen corrections like this. This is really nothing to write home about. On the other hand, what happens when the market takes the next big scare? Is this going to be the beginning of a next big psychological scare? I agree. I don't believe that there's going to be a negative wealth effect, and I don't believe that the global economy is in any peril. If anything, everything is looking kind of rosy for the global economy, except for the fact that this has been going on for some time, and that's what has the markets really worked up and worried, is how long can this trend be sustainable. So obviously,
okay.
That's what's going on. But to get back to your question about the risks in the system, there is a debate about whether the new technical instruments in the market are a factor of more risk, or on the contrary, whether they allow more arbitrage and the emergence of more hedge funds allows the market to absorb more shocks.
Why don't you comment on that? The fact that we're interconnected like never before via globalization, does it mean more systemic risk or less?
Well, a couple of points. The top line correction, as it's being called in the main indexes, hides a lot of damage beneath those indexes. The transportation average in the U.S. looks horrible. The Goldman Sachs, Merrill Lynch, Morgan Stanley, these stocks are getting shellacked. There's a huge recognition out there that this financing craze, most of the profits in American business come from the P&L, the financing, the banking divisions. General Motors Acceptance Corporation is the profits of General Motors, not cars. Obviously, if they could make cars, they wouldn't be having their lunch handed to them by the Japanese.
Well, let's get back to the question, though. The state of the global economy today, just the fact that we are interconnected the way we were never before, the fact that the varying economies in the global economy are more and more increasingly dependent on each other. Are we at more risk or less risk now?
The world's been interconnected before, globalized in this way, right before World War I. There was a tremendous period of globalization. This is not necessarily all that new. It's electronic and fiat currency, which is being loaned into existence to the trillion-dollar marks, to a multi-hundred trillion dollar derivative markets surrounding a global GDP of, let's call it 50 trillion. So there's 10 times more speculative derivative trading than there is actual output if you add it all up for the entire globe. That's not a healthy sign. The money supply is growing around the world at double-digit rates. In the UK, it's 14%. The economy can absorb all this money. They're also talking about introducing black exchanges, dark exchanges, unregulated exchanges. This is a black market we're talking about. This is a mafia system.
Okay,
this is not capitalism.
let me ask Stan Jonas over in New York. Do you believe there are real risks posed by how people trade and invest today?
Correct. Yes, but I think that this sounds like a medieval conversation about things that we don't know anything about. Let me start with the greatest economist of capitalism, Karl Marx, who told us that when we analyze things, the question we should ask is qui bono? Who benefits? And when I hear this, the only people that benefit in the American system with all this risk and talking of volatility are the hedge funds. The hedge funds have had a disastrous performance over the last 4 or 5 years. Why? Because things have been calm, boring, insatiably on course. And so what's happened is we hear these kinds of plaintive cant. The world is coming to an end. We need volatility, because otherwise the rational strategy is just to do very little and to stay put. And let me ask the one question. When you say the word risk to whom? I will guarantee you that no matter what happens to the stock market in the United States yesterday or the day after, there will not be one manager of equity positions who will be fired. That's because everybody has the same positions. Everybody's in a mutual fund. People all have the same portfolio, and there is no risk in the system except for those people that have to understand what asset class there is. So whether the stock market goes up or down doesn't make a bit of difference to 90% of the people in the world globally. It doesn't make any difference at all. Now, people could rail about it and say it's going up and down, but there's no results. We are basically immunized against risk in that regard because nobody gets paid for performance. Nobody cares whether it goes up or down. Nobody's going to change. You're not going to change one iota what you're going to do tomorrow because the stock market went down today in the United States and Shanghai. Nobody you know is going to change their life in one format or another. So what we talk about are interesting speculative vehicles. It's nice the thing goes up or down. Some hedge funds made money. Some hedge funds lost money. But in terms of the systematic risk in the society, it hasn't changed one bit.